This is a continuation video from the last high probability trading model where I talked about the model with a few examples. In this video, I'm going to talk about a few more examples and also we'll try to blend all the concepts together. So let's get into our first example. Now, when I talk about blending all the concepts, right, invariably starts from really taking the bias from higher time frame, or at least noting down the arrays on the higher time frame that helps or assist in making the decision for trading intraday, right? So whether you are scalping, whether you are maybe trading for a longer duration, maybe through the day or for a session, whatever it may be, this is really more or less the starting point. So this, what we're looking here is a 1 hour NQ chart. And if you look at this chart here, this was one of the day's high, Thursday high as indicated. Now the price comes back, goes back and forth, right? Got into this chop or consolidation, you may say. And this is, by the way, an hour chart, right? So, you know, it sort of transpired over 2 days, right? From here to here. And then a lot of these buy side that I have marked, internal buy side liquidity built. And then this is where the price is, right? And I have taken this snapshot at 9 a.m. on a particular day. So right before the New York session. Okay. Now, what I want you to see here or notice is that when this action happened, this particular internal range liquidity on the sell side was purged. So that's one. Number two, if you look at this price action, this entire thing became an order block. So this candle also is an order block. So if you look at it, I have marked the body of this candle as order block right here. Now, what you also see is that this is an order block, right? This area. And then you see this candle right here. So with the close of this candle higher than this, this becomes another order block. Now this order block, smaller one, rests in the bigger one. By definition, that's called a propulsion block. So a propulsion block is nothing but an order block, but really residing in another block. And idea is that when you have such kind of formations, you can generally expect a fairly intense price action, right? Because think it like a spring, right? Where it's like loaded, it's a strong spring, so you're loading it and then you're immediately getting a reaction, right? Jumping on it and you're getting a reaction. It's just something like that, right? In terms of price, one order block residing in another order block, right? So this is what propulsion block is. Now we also have a BISI here, as you see here, right? From this candle. So this is all the price action right at the market open. Okay, so have this context in mind because that is what is important, right? When as you will see in the next slide. Now, one other thing I also want to point out is that typically when you see a large wick like this, right, in a candle, many a times you will see the price would react from the midpoint of the wick. So when there's something like this happens, I mark the midpoint of the wick as well, and that is nothing but what's called a consequent encroachment, or call it a mean point of the wick. Okay, which you see the reaction here. So that's what it's listed here. But so this is really the setup. Now what I also want to share here is talk about is the SMT that was playing in the mix, right? So this is an NQ chart, the chart that we just saw, and by the way, this is a 15-minute chart, but again the same day chart right at 9 a.m. before the market open. Okay, you see there was this SMT that happened between ES and NQ. And this was during the overnight session. So when you have something like this, especially at the session low, you mark it, right? Because this is really can be a start of a bullish trend, right? SMT at the bottom. So this is something also, you know, that's marked. And as we talked about in the video earlier, SMT is nothing but the crack in correlation in a highly correlated assets, right? Two assets. So here it's NQ and ES. So this is a bullish SMT. So this is another thing that we just marked here, right? And at least took a note. Now let's get onto a 1 minute chart. So again, if you look at this chart, this is nothing but this BISI on the 1 hour that we just saw, right? I have divided that in quadrants, but this is nothing but the BISI, and this is really the propulsion block open, right? The you know, that the one that we just saw in the block. So when you see the price open, the market opened somewhere here, 9:30, went, then came back all the way back. Now in process of that did what? Purged this internal sell side liquidity right here. Okay, and where did it reverse from? It reversed from right at your that order block or the propulsion block that I marked in that earlier slide, which was right here. This blue line came here and then started to sort of react from here, right, and reverse. So now what you will see here, I have marked few things, and this is how you do it, right? So right at this point in time, the 950 macro started. Now when the 950 macro started from here, the price came all the way, got to the PV open. So you see how this larger time frame here is working, right? And then it's got a push. When this candle closed above here, sorry, right here above this candle, this became a bullish breaker. Okay, so I have marked it as a bullish breaker right here. Now at this point in time, what are these signatures? These signatures are bullish. Why? Because once the internal sell side has been taken on the higher time frame, we've seen that a lot of sell side was taken, and this could be a potential point of reversal. So alignment with the higher time frame, and now this candle in closing making it a a bullish breaker, right? And not only that, this particular macro, when it started, also with this candle formed a smaller fair value gap that you will see, right? It's macro FVG, not too big, but these are like the bullish signatures, right? Now I'm not going to be talking in terms of trade level details on this chart. I guess by now you have enough number of examples, but just see how you read the order flow. That's more important, and accordingly you can place the trade. So at this point in time, the order flow was confirmed bullish. So now if one would have taken the trade, what would be the ideal target? This opening range high, or this nearest buy side liquidity, right? But let's look at the order flow. What happened here? Right here, if you see, there was this price action goes higher, comes down, and then we saw this kind of an action. So if you again pay close attention, between this macro right here, this became an inversion with this candle close, right? And macro inversion is a significant inefficiency. That's why I've marked it here as inversion. And then from there on, from inversion, you would expect, if the order flow is still bullish, you would expect this inversion to hold and then push the price higher, and that's exactly what happened. And then it took the opening range high. Not only that, in fact there were other internal buy side liquidity that was marked on that 1 hour chart. You see it took that and took all of it, right? So it just kept on going. So you see how we are using the higher time frame and then forming a narrative, right? Let's say a bullish narrative in this case, and then using a smaller time frame like this on a minute chart, and then using macro and our trading model to really get into the trades, and then targeting the price that we want to hit, right? So this is what I say, what I mean is blending the concepts together, right? Now on the very same day, later part of the day, you have this price action, and again I want to elaborate on that because this would also help to sort of again bring the concepts together. So price reversed, I would say retraced. We saw some retracement on this side. Now where did it retrace to? At that point in time, there was a 4-hour order block, bullish order block, and it reverted right to the mean of it. Okay, so when you have something like this, right, you make a note of it, because if you have an order block and if it mean is where you can see a potential reversal, right? So you have it here, and when you see an action something like that, right, it's sort of added confirmation that the price actually gonna be reversed if you see bullish signature on this 1 minute chart, right? So this was this first action. Now during this time there was a macro, right? The 150 macro right here. So there was this particular CB that was formed, and then there was this CB formed, right, during that macro time frame. So I've marked it. But then when it started to reverse from here, when the price, this candle, when this particular candle, this price action, when it closed here, this became high probable inversion. Why? Two reasons, I would say. One is that it is a significant inefficiency, macro inversion. But number two, you see when the price was going down and delivering to this, let's say, objective, which was delivering to this R block 4-hour order block mean threshold, this was the inefficiency that was used to deliver this, right? So when it inverted, this becomes by definition a high probability inversion. Okay. Similarly, when the price goes, closes above here, this also became a high probability inversion. And you see, before this, when the price was coming down, what happened? It tried to go higher, but then this guy said no, you're not allowed, right? Came back, tried one more time, no, came back. Okay, so you see how this PD array or this array was engaged to deliver the price here. So finally, when this got closed, these inversions became high probability inversion. Now, if you want your, what would you rather expect after this, right? These are all bullish signatures that this particular inversion support price to deliver where? The nearest buy side liquidity and next set of liquidity. And that's exactly what happened. You see, it got delivered here. So you see how you're sort of building a narrative and then bringing all the concepts together. All right. Now let's get to our next example. This is again a simple example where I've used an order block, right? So this is an 1 hour chart, and I'm using these hour charts. Sometimes you will see me using 4-hour daily just to narrate how you're using the higher time frame bias in your trading decision. So this is a 1 hour, right? So a lot of back and forth choppy price action. Now here is, I guess, a price action on this particular day, which was close to the market hour. And you see here, this was an order block that was formed. Why is it important? Because you see the price engaged from here and then reverted back, right? So you have to identify the array where the price is engaging, right? To which the price is engaging. This was the array that was the price was engaging for, right? So I've marked it. Now let's get to the next slide. And so you see this one is the order block and this one is the mean of the order block. Now exactly this is the point here, the mean of the order block, right? So literally to the tick here, maybe just 1 tick lower. When the price started to come down, this is relative equal high. So this is a pool of liquidity getting built here. Then there was this back and forth, some liquidity built here, then came down, delivered to where? Right to the mean of this order block, right? The 1 hour that we just saw in the earlier slide. And then with this close of candle, there was a change of state of delivery. Why? Because this became an order block, this particular candle, as this candle closed above this, right? So that's why there was a change of state of delivery and then become a bullish order block, right? So this is like the first sign of reversal when you're seeing the change of state of delivery, especially after reacting from a higher time frame key reference point. Then what happens? This all happens at the 950 macro. Then you have this BISI that was formed, and see you're using the BISI to deliver to your buy side, right? And then what happens? 1050 macro goes higher, comes back, and then finally this particular fair value gap was reclaimed right here, right? And where would you expect this particular BISI to deliver to your other pool of liquidity, which is relatively equal highs right here, and that's what it got delivered to, right? So again, as you practice this more and more, and as you look into your charts and do tape reading, all these concepts will become a lot more clear. You need obviously a lot of practice to get to a place where you start to feel more and more comfortable, right? Identifying it real time, more importantly, as it happens, or as the candles are being printed in a live market. Now let's just talk about another few examples. So far what you've seen is I wanted to give a sort of all kinds of trades, right? So far the example that I've talked about in this video are all where I'm using the higher time frame bias because I have a clear bias, and I'm using that and combining that with a model, right? High probability model to structure trades. Here the next couple of trades that I have listed here is again on days where you are more of in a scalping mode, right? Because or you are there is really no clear draw, or the drawn liquidity can be on both sides, right? You can frame it both ways, etc. And many days are like that, right? So the next few trades I have picked up in this example are from one of those days. So you should look at again this price action, right? So this was I picked a day where I've taken maybe a couple of trades. Where was this? So this is a 50 macro, right? It's running, and if you look at it with this candle close here, it became an inversion, right? So macro inversion, which becomes a high probability. Price goes higher, comes back. Look at the, how the, basically these candles all using the same inversion. Okay, most of them are actually even closing above 50% with this one exception. But again, close above it right here. So what happens? High probability inversion being used to deliver to your liquidity. This was the last day PM session high, right? So liquidity that you have identified, and it got delivered to. But between doing that, also you will see that this particular area, right? So buy side, sell side. So, or again, you can think about it this way, right? Sell side, buy side. So this is also a balanced price range that got formed. Okay, and you got to mark that as well, because a balanced price range are, again, if the price is closing above it, then provides a very strong support. And this is what you see. So as you are doing all this and you're marking all these, arrays, you will start to see, for example, here, bullish signature. Why? Because see how many times it tried to wick into, but did anybody even close below this particular BC here? No. Did anybody close below the BPR? No, right? It wigged, maybe 1, 2, 3, 4, 5, 6, 8 times. And then the price pushed higher, right? So this is like nothing but the smart money footprint, right? This is how you sort of internalize the price action as you are in the trade, because one could have gotten into a trade right here targeting this and this. So as you are into the trade, when you see even candles printed against your trade in opposite direction, you still have ways to assess that this is all part of the normal routine. There's nothing really concerning, right? As far as your narrative concerned, it still holds, and and the price would ended up delivering to the targets here, right? So this was the first trade, and in fact for me the trade was right at the top of this inversion with a stop loss below few ticks of this inversion, with target being this one and this one, right? So this was the trade. And then let's talk about another trade the same day. And what you will see here is again very, very simple trade here, but SMT at the top, which was a bearish SMT, and then there was this this 10 a.m. news here. So this this particular FVG got printed from the 10 a.m. news, and then that got reversed. And then finally, when it was reversed, the price was doing something. But then finally, when this particular candle was closed right here, you see this again, the 10 a.m. news fair value gap was inverted, which is a significant inefficiency. And there was a London low right here on that day. Also, there was this H1 BC, wherein if there is a BC, then typically to rebalance it, you again remember price does two things, right? To liquidity and then trying to balance inefficiency. Here it was getting both liquidity right here and inefficiency right here. So generally this works as a magnet, and when the the closure was here, one could have taken a trade here. Also, if you really look at it, this particular thing, right, because this was during a macro, this became a when this was inverted, this candle closed, this became a high probability inversion. So one could have taken the trade here as well, right? So many ways to really, I would say, look at and read at the signatures, but the simplest of the signatures reading here would have been a close below 10 a.m. news, a fair value gap, and then using this as an entry, and London as the lowest hanging fruit, and maybe this London H1BC, the top of it, as a next target, right? And boom, got delivered. So trade 2, and then trade 3, same day, I guess, but this was during 1050 macro, and there was this action. If you look at it, this 1050 macro itself, so the macro took the sell side, and then finally there was this aggressive price action. And there was, by the way, if you remember, we have all talked about new week opening gaps, right? So this was a new week opening gap high for that week and low, and you see I have marked it here, and the price delivered right to the new week opening gap low. Okay, so this was one of the key PD areas that was delivered to. Then there was a reversal, and when there was a reversal, there was this this BISI that was formed, right? And then finally the price went higher. There was a change of state of delivery with this close of candle, and then there was the buy side in this area. What you're using it then, because this price action delivered to one of the key PD areas, right? The significant inefficiency, change of state of delivery, then all you're looking for is a bullish signature to get onto the trade, right? And then attacking the buy side liquidity. So the important point being that if you are able to start identifying these signatures, then the trading becomes very predictable, right? You can press the button without any hesitation, right? And you would also know the point of invalidation of your trade, and generally that is below your array that is supporting, right, your signature, whether bullish or bearish. So below the, in case of bullish, above in case of bearish, right? And then attacking the liquidity pool. So again, if you pay close attention, it's the same concept that I've been talking about, right, which is being repeated and sort of every day, right, day after day after day. It's just about recognizing those signatures, and more importantly, forming a narrative looking at those signatures, deriving the bias from higher time frame, right? And that sort of blending it all together is what really makes a really, really good combination. All right. So last slide on this video, and this is where I want to end it, right? So if you remember, when I talked about the high probability trading model earlier, I said we'll revisit the entry, exit, and stop after we have gone through examples. So we have gone through tons of examples, right? So let's visit this entry and exit and stop. So entry, always, if you recall all these examples we've talked about, the entry is always after you verify the signature, bullish or bearish, right? And so in case of a bullish signature, it would be the bullish signature would be in form of a price that is closing above an array. So let's say if there is an FVG that needs to hold or that needs to be inverted, we want the price to be closing above that FVG, right? And then take that. So that's the bullish signature in this case. Similarly, there is a high probability block, high probability order block. Now we want the price to go close above that and then come back and then test it and then take off, right? So that is where your entry would be, right at once your bullish signature is confirmed or your bearish signature is concerned, right? Similarly, the exit would be at the nearest identified liquidity. As I talked about, there's always a low hanging fruit, and typically in my trading style, what I would suggest is always have multiple contracts. Now if you're trading with minis, have multiple minis. If you're trading with micros, have multiple micros, right? It doesn't really matter, but having that flexibility always helps in the trading. So the first has to be exit always has to be the lowest hanging fruit, which is the nearest identified liquidity point, and then the subsequent exits can be whatever liquidity pools you've identified later. It could be a session one, it could be a daily liquidity or whatever, right? And so on. Stop, it is really the swing low below the array that is supporting, let's say, your bullish price action, or the swing high above the array if your price action is supporting bearish signatures, right? So simple. As you can recall, right, me sort of talking about those stops in those examples. So this is by and large the I would say the rule that I apply for entry, exit, and stop. Now in some cases, let's say you're taking an entry on an FVG, but that FVG itself is like 50 points wide on NQ. Now 50 points wide on NQ is a large one. So in that case, what I would say is, in those scenarios, just look at the midpoint of that fair value gap, for example, right? And have your stop below, let's say, one tick below the midpoint, right? Because you also have to look at your risk reward and so on, right? So for something like that, where you are encountering these big FVGs or really wide FVGs, right, or order blocks, you always can use your midpoint as your stop, right? So that's just a thumb rule I apply in those sort of scenarios. So again, I guess with this I'll close this video, and just to sort of I'd say summarize, we've talked about two models. The first model in our video series I talked about was the intraday model, right? And the second was I talked about the high probability trading model. Now, high probability trading model, as you see, is you can use it very, very effectively even for scalping, right? The intra-trading model was more about using the high time frame bias and then getting into the intraday trades. But at the end of the day, if you really look at it closely, almost each of these models are blending the concepts together, right? So more or less, if you're able to understand and blend